it is confusing sometimes to hear critics say, you know, there's no risk management. We have risk management throughout the firm. We have minority owners who are overseeing the risk in the firm. So we are looking at Ark as a slice of an equity allocation. And we have a study on our site, Ark-Invest, which shows that if you allocate, I think the study was 5 to 15% to Ark, take that from other equities, we will, over a 5-year period of time, increase your return per unit of risk. And that is why over the last 5 years, we have outperformed when most active managers have not. We have outperformed the NASDAQ and the S&P and the MSCI. So I agree with you that you know, what I call tried and true, the core, many people treating Ark as a satellite. I think many people are, and as a hedge against the massive disruption that we see from innovation during the next 5 to 10 years. It's going to hit some of the stocks in traditional benchmarks.
It's amazing how much engagement you're able to get. I think you and your colleagues together have like 1.7 million Twitter followers. And then you've got on the other side of the coin, this sort of legacy active where the PR people and the lawyers don't let them say anything. And if they do, it's very by the book and it doesn't really get anybody going. Nobody cares. I will say though, I think it's good. I think it helps your brand, but sometimes you'll say something and I'm like, oh, why did she go that far? For example, the 40% return. Sometimes you'll throw out a number. I'm like, why set the bar that high and maybe, you know, upset your compliance person? Like, I think people are you know, with you. Because don't you want to under promise and over deliver?
So, well, in the beginning, we wanted people to just listen to our story, so maybe that's part legacy. But our chief compliance officer spent 4 years at the SEC as they were evolving guidelines for social media and marketing. And I started the firm saying, okay, after 08, 09, what did clients want? There was a loss of trust in the financial services industry, so transparency seemed to be very important. So that was, I invested much more in marketing at the very start of the firm than most would for this idea. In terms of the putting numbers out there, what we try and help people understand is the other side of what you said in terms of our return expectations based on growth, based on our research, is we're also, and people don't pick up on this as much, we're also saying these expectations are with an assumption that our multiples are going to compress dramatically. So I think many people are surprised to learn that Tesla's EV, so enterprise value to EBITDA, our expectation in 2026 is 14 times. It's below a FANG today. Now, do we think it's really going to be there if autonomous takes off? No, we don't. But where you do see aggressive assumptions, and this has to do with exponential growth revolving around Wright's law, Moore's laws relative, we have a high degree of confidence in the unit growth characteristics as these technologies go mass market. And we're really trying to communicate that. These technologies cutting across sectors are creating explosive opportunities.